Good morning, everyone. My name is John Paul Ruiz, Director of Professional Development here at the Entrust Group, and welcome to the webinar titled The Key to Understanding UBIT and UDFI. Again, we appreciate your participation in this particular course to learn more about this wonderful tool that allows for individuals to be able to grow their wealth inside their retirement plans. But before we get started, I'd like to put out a disclaimer out there that the Entrust Group does not provide investment advice. We don't provide tax advice or legal advice or endorse any products. One of the things that has driven our business for the last 38 years is education. And it's all we're trying to do is raise awareness of these possible tools that investors could use in regards to their retirement plans that they could bring to their tax or legal advisor and explore more opportunities to grow wealth, again, using their retirement plan assets. All the information and materials are for educational purposes only. All parties, again, are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. Again, the Entrust Group does not claim to be an investment advisor, a legal advisor, or a tax advisor. So be prepared that if you do ask us some tax questions, that we will refer you back to your tax, legal, or investment advisor. Now, what is today's webinar about? First, we're going to talk about the Entrust Group. We talked a little bit about it already. First, let's go over quickly what is a self-directed IRA, because this course is mainly about assets that are held under a retirement plan, mainly an IRA, whether it be a traditional IRA or a Roth IRA. My first job is to demystify that term, self-directed IRA. What are the benefits of self-direction? And the next thing we're going to do is go right into what is UBIT, UB or UBTI, and last but not least, UDFI. Those acronyms are very helpful in regards to growing your assets again. What is the criteria that incurs UBIT in retirement plans? In other words, what creates a taxable event for investments under a retirement plan, which is typically tax deferred? People have asked me before, John Paul, I thought all earnings in retirement plans are tax deferred. Well, the answer is it depends. Generally, they are. However, there are some investments that could generate UBIT, or unrelated business income tax. What are the exceptions to UBIT? How come some investments are not taxable, or the earnings on some investments are not taxable? Because there are certain exemptions. And last but not least, how do you get started by setting up a retirement plan at the Entrust Group? In other words, you want to take a whole, or in part, or in other words, a portion of your retirement plan to invest in investments that you have chosen. In other words, some organizations who offer IRAs may say, you can have that, but we just can't do it in our financial institution. That's where the Entrust Group comes in. How do you get started with the Entrust Group? And last but not least, we're going to open up the floor for any questions you may have. So as we go through the material, please jot down your questions, and would love to answer those questions for you when that time comes. The presentation of the material will go approximately half hour to 45 minutes long, and then the last part we will open up the phone lines for any questions you may have in regards to the material presented. Excuse me. Well, a little bit about the Entrust Group. The Entrust Group is a self-directed IRA administrator. Not only are we a self-directed IRA administrator, we also have other organizations that are partnered with the Entrust Group to not only administer but also custody the assets. I don't know if you know this. For those of you who are listening, we do have a trust company out of Tennessee, chartered under Tennessee, regulated by the state of Tennessee. So in other words, not only do we do the day-to-day work for your IRA, including but not limited to, processing transactions, as well as the yearly things which has to be done in order for your IRA to be compliant, such as IRS reporting, fair market value reporting to the Internal Revenue Service, and other things that are associated with keeping your IRA up to date. We have been around nearly 40 years of service. I said 38. I forgot we just had an anniversary. So we are almost 40 years in service. We have over 22,000+ accounts. We're one of the larger self-directed IRA administrators. We do not just take on any account because we do reserve the right to say no to certain types of transactions, but we have been around for quite a while, and our seasoned staff will be more than happy to answer a lot of your general questions. We administer over $3.3 billion in investor assets. And last but not least, we still do have people that you can actually talk to in regards to your account to ask general questions, ask for resources where you can find your answers in regards to having a self-directed IRA. Now, the Entrust Group doesn't just educate consumers, we also educate the industry. Our courses are approved for certain designations for continuing education credits, including but not limited to the CFP board, Certified Financial Planner Board. We are also an approved continuing education provider for the Internal Revenue Service, as well as National Association of Boards of Actuaries and Accountants. Not only those particular designations, we do own a school as well. As a matter of fact, we will be having one next week in Nashville, Tennessee that educates financial institutions to get what we call the Certified IRA Services Professional Designation, which is a designation through the American Banking Association. It's one of their designations to the professional certifications. We do have nationwide offices, and some of our staff can actually deliver some of those educational opportunities. If you are a practitioner, or in other words, somebody who actually gives advice to individuals and you're looking for CE credits, we have done those types of educational programs as well for realtors or CFP, CPAs, tax consultants, dealing with general retirement plan rules. Again, last but not least, we are going to have our IRA Academy next week in Nashville, Tennessee, that will prepare individuals for the Certified IRA Service Professional Designation. Well, enough of us. Let's get down to the heart of why we're here today. But first, let's take a look at what a self-directed IRA is. Let's demystify that. Well, there really isn't such a thing as a self-directed IRA when it comes to what Congress has created on the different types of IRAs. You have your traditional IRA, your Roth IRA, your SEP IRA, which is nothing more than a traditional IRA, but it received what we call an employer contribution called a Simplified Employee Pension Plan, or a SEP contribution. But once that contribution hits a SEP IRA, it's basically treated just like a traditional IRA. Last but not least, a simple IRA. These are individual accounts that people may hold, and contributions have been contributed to these accounts. Of course, there are limits involved. Attend one of our courses called a contribution course, and we'll talk about the limits then, but that's not the focus of this particular course. Contributions to these particular types of IRAs can be invested in a broad array of investments. There are only 3 different investments that you cannot have. You cannot hold under an IRA. One of those are life insurance contracts, and number 2 are collectibles. Another type of entity, which by virtue of the nature of an IRA, which is a trust, a grantor trust cannot be a shareholder of what we call an S Corp. So in other words, if an IRA holder would want a director or custodian to invest in an S Corp, well, you can't do that. There's a Revenue Ruling 92-73 that basically disallows for an IRA to be a shareholder of an S Corp. But for all intents and purposes, you can have the universe of other types of investments as long as you're not engaging in some sort of conflict of interest called a prohibited transaction. That's where a self-directed IRA administrator comes in. Let's just take the Entrust Group. We're just one of many, but we actually have helped a lot of them get started, because we've been around for almost 40 years. A self-directed administrator says, I don't offer any investments. Well, what does that mean, John Paul? Well, basically, a self-directed IRA administrator offers the platform that allows for you to have a retirement plan at their platform, but you, the IRA holder, gets to choose the investment you want to hold under your platform, under the platform, which means that the infrastructure of a self-directed IRA administrator is designed to hold and administer investments that are typically not going to be held at your traditional types of financial institutions, such as your banks, which offer CDs, money market accounts, and savings accounts. And some of them may have an arm called a broker-dealer, which basically deals with what we call stocks, bonds, and mutual funds. We are also not an insurance company, which insurance companies offer your IR annuities, so whether it be a traditional or a Roth. Again, those types of financial institutions offer some sort of investment that you can hold under the retirement plan, under the IRA at their institution, whereas a self-directed IRA administrator does not offer any investments. But you, the IRA holder, can choose to, number one, locate, research, as well as vet out, of course, with some assistance of your competent tax or legal advisor, on whether or not that will be a good investment for you. The Entrust Group does not do that. All we do is provide the administration of your IRA as well as the custody. In other words, somebody has to take hold of your asset, because if you hold it, it becomes a taxable distribution, or it becomes a distribution in this case. So we offer the two components that is required to have a retirement plan, but you, the investor, gets to choose whatever types of investments. Now, there are a broad array of investments available out there in the marketplace, such as, private placements, notes. In other words, you can your IRA can loan money to somebody else. Individuals may invest in businesses, and individuals may also invest in real estate. And that's where the UDFI and UBIT comes in. The self-directed platform offers you to diversify your portfolio dramatically, better than any other type of institution. Why is that? Because you can hold just about anything underneath your self-directed account. Whereas if you're in the stocks, bonds, and mutual funds, you may have diversified your portfolio in the stocks, bonds, mutual fund world, but you're still in only stocks, bonds, and mutual funds. If you're working with a registered investment advisor, somebody who's actually licensed to give advice, you may want to explore other opportunities, or if you have an appetite for other types of investments that cannot be held at other financial institutions, such as real estate, precious metals. That's where a self-directed administrator comes in. We don't call ourselves the magic pill, but we do play a big role in your toolbox as you diversify your portfolio, your retirement plan portfolio. Again, if you cannot do the due diligence yourself in a self-directed account, we would highly recommend that you seek out a competent tax, legal, or investment advisor. Pull them in, and we'd be more than happy to speak with them in regards to the rules in regards to retirement plans. All right? The benefits of self-direction, again, here it's encapsulated in the slides. You can take control. You can make your own investment choices. You can diversify your investment choices as well, because just because a financial institution cannot hold your asset doesn't mean you can't have it. There are also tax savings in these self-directed accounts. Why is that? Because they are tax-favored retirement plans. Traditional IRA, if you make a contribution and you're eligible for a tax deduction, that will reduce your taxable income for the year. If you're a business that would like to bank away certain portions of your profits, of course it has to be equally contributed across the board to all of your participants, but if you don't have any employees, then the contribution will go to yourself. Let me give you an example. A SEP plan, the maximum contribution is the smaller of, the lesser of, 25% of your income for the year, not to exceed $56,000 for 2019. That's a substantial amount of cash that you can bank away and not have to pay taxes on it, and reduce the amount of taxable income you have for the year. Now, keep in mind, that amount is just tax deferred, which means you're postponing your taxation at a later date. Now, there are other types of retirement plans that goes beyond the traditional IRA that I talked about. in some retirement plans, such as the Roth IRA, the contributions do not get the tax deduction. The earnings still grow tax deferred, but later on, how would you like it if all the earnings in that account is tax-free? In other words, there are tax benefits in regards to having a self-directed account that you would get in a self-directed IRA account that you would get the same as an IRA at another financial institution. But the investments that are available to you are broader, which includes, again, real estate. If you want to invest in a business, you want to invest in a Facebook, the next Facebook, a private placement, precious metals. Yeah, explore it with your tax, legal, or investment advisor, and speak with one of our representatives, and we'll be more than happy to chat with you in regards to how we can possibly make that happen for you. Now, what is UBIT? In some cases, UBTI. Don't be confused by those terms. All it is what we call unrelated business income tax. That term comes from the tax that is associated with income received by a tax-exempt entity. Now, when I say tax-exempt entity, mainly what you call your 501c3s. 501c3s basically is an organization that was formed directly for a socially responsive topic, such as religious, or whether it be furtherment of the arts or furtherment of education, or certain types of socially responsive types of acts, right? The more common ones are your religious or with the furtherment of the arts, whether it be revitalizing a certain portion of a particular community. Anyway, it's socially responsive. Now, those types of entities do make money. They just don't get taxed on it. Sound familiar? Similar to your IRA. Because an IRA also falls into that category of a tax-exempt entity. But where does UBIT come into play? Nonprofit entities or tax-exempt entities like those typically don't get taxed on the income that they receive. Let's use an example. Let's say an art gallery. An art gallery in the IRS publication, as an example, will not get taxed on postcards that it may sell that is basically marketing the art within that art gallery. There are certain types of incomes that they can generate without producing taxation. However, let me give you an example. Let's say the art gallery rents out the art gallery for a wedding. Now, come on. Obviously, the wedding is not one of the tax exemption focus of that organization, because it's supposed to be for the arts. Uncle Sam says that act that you did is unrelated to your tax exemption. That's where the term unrelated comes into play. Therefore, that income that you receive, even though you're a tax-exempt entity, will now be taxed. Based on that concept, let's apply that to individual retirement arrangements. Individual retirement arrangements, or IRAs, are intended for retirement. It's not intended for you to start a business and have your business not be taxed if it's owned by your IRA, because that business should not have a competitive advantage to another type of business that is not under an IRA. Let me give you an example. Let's say somebody owns a laundromat. They're not under an IRA. Of course, the income that they will receive will be taxed on that, so their pricing is based out of that. What if your IRA decides to invest in a laundromat? Well, the IRA cannot say, in our laundromat, we only charge this much because we're not going to get taxed on it. That business cannot have a competitive advantage in comparison to another business. Therefore, the income from that trade or business will now be taxable under an IRA. That's what generates what we call UBIT or UBTI. It's an unrelated business income tax for incomes that are generated by an investment held under a retirement plan. All right, that amount is going to get taxed because it's a trade or a business. Again, in simplistic terms, if your IRA is going to invest in an asset that will incur income from a trade or a business, it will get taxed because it's not going to have any sort of competitive advantage over another business outside of a retirement plan. Now, since an IRA is a trust, trusts are taxed based on their own rates. So in other words, the income received by that business will be taxed at trust tax rates. Now let me qualify that a little bit. The IRA will have to file a tax return, and as a matter of fact, will be taxed on that income if the gross receipts of that particular business is $1,000 or more. In other words, if it produces less than that, well then no harm done. But if it's $1,000 or more, then that IRA will in turn have to file a tax return based on the income that it received from their part of their ownership of that particular business. Now, how does that apply to real estate, which typically in individual retirement plans that own real estate, the income is not taxable. In other words, the rental income, considered passive income. In other words, Schedule E income. Rents and royalties are typically not taxable. Well, there is such a thing as the IRA borrowing money in order for them to be able to purchase real estate. Well, if the IRA borrowed money, Uncle Sam says, well, proportionately, whatever the amount that you borrowed based on the income, well, we'll tax that portion that was associated with the amount that you borrowed. That is what we call UDFI. Now, I'm just giving you a high-level overview of it first, and then we'll drill down to the detail in a second. UBIT or UBTI, again, is tax on earnings or income by an investment held under a retirement plan that's considered a trade or a business, or income by the IRA that is associated by an amount that was leveraged or borrowed. In other words, if the IRA gets a loan to purchase a particular asset, well, that proportionate share of the amount that they borrowed will be applied to the income, and whatever that percentage is, that amount will be taxable, taxed at trust tax rates. Again, now there's a lot of stuff that I'm going over here, but you know what? Write your questions down. We'll be more than happy to answer those questions when we open up the phone lines for the Q&A session. Again, what is UBTI? The acronym is for unrelated business taxable income, or unrelated business income tax, all right? If you are going to invest in something like of this particular scenario, pull in your tax advisor right away. Why is that? Because there may be some tax returns that you would need to prepare that your custodian will sign on behalf of the IRA and file to the IRS. Now, given the fact that an IRA has to file a tax return, well, then the IRA would have to get its own employer identification number, or EIN. So be prepared to do that. It will not fall under the EIN of your custodian. Your custodian basically holds multiple accounts that have this type of income. Therefore, imagine all of those being filed under one EIN. That will be confusing to the Internal Revenue Service. So the IRS requires that if an IRA has to file a tax return, well, it has to file for its own EIN. As a matter of fact, electronically, you can actually apply for an EIN for an IRA under the it used to be called a Form SSA, but you can file it electronically and get an EIN for your IRA if it has to file what we call the IRS Form 990T, which is a tax return for a tax-exempt entity. Now, what is UDFI again? It stands for Unrelated Debt Finance Income. It's when an IRA borrows money to buy a particular investment. The percentage that was borrowed will be applied to the income to determine the amount of the income that's taxable. All right, UDFI is a type of UBIT or UBTI. UDFI is a line item on the IRS Form 990T where the IRA has to file a tax return for that income, which is taxable at trust tax rates. Now, let me give you an example of how UDFI works, all right? Let's say you have somebody that has $100,000 in their IRA and they want to buy a $200,000 piece of property. Well, of course, they don't have enough to buy a $200,000 piece of property because they only have $100,000. The IRA can actually borrow. Well, John Paul, how can the IRA borrow? It doesn't have any income. Well, that tells us that the lender will have different underwriting guidelines for that loan. In other words, the loan will have to be self-sustained. It has to be enough income in there. The lender would also probably have different loan-to-value guidelines. In other words, these lenders would probably want more skin in the game. In other words, your down payment from the IRA is going to have to be larger than your typical loans. The ones that I've seen out there is a minimum of 50% down payment. I've seen it as high as 75 to 80%. These loans are also what we call non-recourse loans. In other words, the IRA holder cannot extend credit to the IRA for the IRA to be able to borrow. If you use your own credit for the IRA to be able to borrow, that is what we call a prohibited transaction. Therefore, that cannot be allowed in that particular transaction. So the IRA has to be able to sustain itself. What I mean by that, some lenders may say, I only loan to multifamily dwellings. I will never loan to an IRA that is trying to purchase a single-family dwelling. Why multiple family dwelling? Because there's more rent. There's more chance that the lender's going to get paid. Well, if the IRA holder says, well, can I use my credit? I would avoid that, because an extension of credit by the IRA holder to their IRA is prohibited under Section 4975 of the Internal Revenue Code. Again, it's Section 4975 of the Internal Revenue Code. With that said, the lender should also know that if there is a default, that the lender can only go after that particular property, cannot go after the IRA holder, because the IRA holder was not a part of acquiring that credit from that lender. That loan is what we call a non-recourse loan. In other words, the only recourse that the lender has is to go after the IRA property and not the IRA holder. I hope that makes sense to you. Now, let's say the $100,000 that is in the IRA is used to purchase the property with a non-recourse loan of another $100,000. Let's say that property earns $20,000 for the year. That tells us that 50-50. 50% was bought by the IRA dollars and 50% was bought by a loan. If the income is $20,000, that tells us that $10,000 of the rental income is not going to get taxed, because rental income is typically not taxed under a retirement plan. However, the other $10,000, which is associated with the 50% that was borrowed, 50% of the $20,000, will be taxable to the IRA at trust tax rates filed using the IRS Form 990T. And that'll fall under the line item unrelated debt financed income. I hope that makes sense. Pull in your tax advisors, again, because custodians do not prepare that form. You would have to go to your tax advisor to have them assist you in preparing that form. And of course, again, the IRA would need to get an EIN number if there is a form that needs to be filed with the IRS. You will never use the custodian's EIN number. Right? Now, UBIT criteria, again, in a nutshell, is generated if the income derived from the asset is based out of a trade or a business. If an IRA invests in an LLC, as an example, that basically that LLC owns restaurants, it's a trade or a business. Property development company. Those are just some examples. And the business occurs on a regular basis. I've been asked before, can you flip houses under an IRA? Yes, you could. Is it taxable? Generally, no, unless you're actually running a business under your IRA. If the business activity is not related based on the tax-exempt status of the account, well, then it will generate taxable income. Right? Most common UBTI generating investments, in other words, an IRA investing in entities, as an example, limited partnership, limited liability companies, investments using a third-party loan, such as a non-recourse loan to buy a piece of property, or sometimes a non-recourse loan may even be a loan provided by another IRA that is not a disqualified party to be able to purchase the property. Some cases, it may just, it may not be a financial institution. It may be just an individual that has agreed to underwrite a particular investment. Now, if you're looking for a list of non-recourse loan lenders, we do have one in our website. the Entrust Group. Now, we do not endorse any one of those non-recourse loan lenders. We've just compiled it as a means of a courtesy to our clients so that at least you can see, you can approach numerous amounts of organizations. It's up to you with your tax, legal, or investment advisor to vet out those particular non-recourse loan lenders if you're trying to enter into that particular scenario with your retirement plan. Why and how is UBIT generated? The purpose of your IRA is to provide retirement income, not run a business again. Income generated by a business may generate UBIT because it's unrelated to the purpose of your IRA, meaning your IRA was not created so you can run your business on a tax-deferred basis. The purpose of establishing your IRA is for you to be able to bank away some cash and with the investments from unrelated parties to be able to help grow the wealth that you have in your IRA. Now, here are some exemptions to UBIT or UBTI. Dividend income. In other words, if you invest in a corporation that pays dividends, that's why most individuals are invested in the stock market, because fortunately enough, dividends are exempt from UBIT or UBTI. Interest income, royalty income, capital gains, and last but not least, rental income. If your IRA buys a piece of property outright and it rents it out, rental income to an IRA is generally not taxable, right? Unless, of course, the property was purchased using a non-recourse loan. Keep in mind, this extends further. If your IRA invests in an LLC, that basically the LLC borrows money to purchase property, well, that's passed on to the member, which is the IRA. Therefore, that income on that K1, that or the proportionate share of that rental income on that K1 that was earned using that loan is also taxable to the IRA. So, but generally, rental income is not taxable to the IRA. Now, how do you get started with the Entrust Group? First, you need to open up an account. Now, you can't just pour money after you open up an IRA at the Entrust Group. There are limitations. In other words, you can either move dollars that are already in retirement plans outside, such as another IRA of the same type at another institution. Those can be transferred into your Entrust account. You can directly roll over assets from an ex-employer's plan, such as a 401k plan, 403b, governmental 457b plan. Those can be directly rolled over. There's a different terminology for that. IRA to IRA is called a transfer. From a 401k plan to an IRA is called a direct rollover. And lastly, you can make contributions to it. As a matter of fact, as an example, the annual contribution amount for a traditional IRA is $6,000 with an additional $1,000 if you're 50 and over. If you have a business, you can also make a contribution of the lesser of 25% of your income, not to exceed $56,000 for your account, called a SEP contribution as an example. Those types of contributions are the means of funding your account. So you open up an account, you fund your account. When you open up an account, custodians out there follow the Patriot Act. In other words, you must have a way for us to get to know who you are. In other words, you have to have a valid ID. And sometimes we might even ask for 2 forms of ID so that we can run the necessary checks required by law for you to be able to establish an account with the Entrust Group. You have to have a valid Social Security number for identification purposes. And last but not least, you have to sign our general fee disclosure, which means that you agree for the charges that we have as an organization. Once the account is open, your account is funded by assets from other retirement plans or contribution. Last but not least, the only thing you need to do is direct us to purchase whatever asset you want to purchase. If it has UDFI, we are prepared to be able to handle that as well, whereas if you ask another organization that typically doesn't handle that, they would not even know what you're talking about. That's what makes the Entrust Group a little bit different from the rest. All right, open up an account, fund your account, and then purchase your asset. Well, I hope you learned a little bit about UDFI, unrelated debt finance income, UBTI, unrelated business income tax or unrelated business taxable income. Now I'd like to open up the phone lines for any questions you may have in regards to the material presented. I am looking at some of the questions that we have here. Let's take a look at the first one. We have about 6 IRA accounts between my wife and myself, rollover, traditional, and Roth. Can we pull all these into one account to invest, or does that each need to be its own account? Well, I wouldn't put your Roth IRA and traditional IRA together, number one. You also cannot put your wife's IRAs and your IRAs together because IRA stands for individual. There's no such thing as a joint account, so you can't combine those together. You can combine all your traditional IRAs into one account. Your spouse can also combine all their traditional IRAs in one account, likewise with the Roth, right? And then you can partner with each other. There are some strict record-keeping requirements that you might want to watch out for, though. Why is that? Because whatever percentage the IRA invests in a particular investment, all incomes and expenses must flow back with the same proportionate amount to those IRAs. In other words, let's say you and your spouse goes 50-50 in an account. If the property tax is $5,000 for a particular property, well, $2,500 must be paid from your IRA, and then $2,500 must come from the spouse. If income comes in at $5,000, $2,500 must flow back to your IRA, $2,500 must flow back to your spouse's IRA. If a disproportionate amount goes back, you might be faced with other with issues, because it has to proportionally go back in and out based on a level of of contribution or based on a level of amounts that were used to buy a particular property. But to answer your question, you can put your same type of IRAs together. You just cannot put all of your assets in one bucket. And I also wouldn't put your Roth in your traditional, because your Roth IRA is typically tax-free, whereas your traditional IRA is going to get taxed. I hope that answers your question. I kind of gave you a long, drawn-out answer because I just want to make sure that I hit all the points before you start taking the first step in whatever endeavor you're trying to do. All right. Next question. Once you sell an asset that generated UBIT, do you still need to file a tax return going forward? Okay, maybe let me rephrase your question. If an asset has filed UBTI, all right, because let's say it borrowed money, all right, eventually that loan is going to get paid off. You know what that tells us? Let's say an amortization schedule, every payment that's made goes to principal and interest. Well, the percentage that the IRA owns continues to increase. And later on, 100% of that investment will now be owned by the IRA. If it's 100% owned by the IRA, well, then there's no UBTI. The UBTI is only generated in a particular tax year, which is a calendar year, that income was generated based out of a percentage that was borrowed. As a matter of fact, the IRS, if you want publication 598 is a good publication to read. Uncle Sam says, we know that, you know, they don't say it this way, but I'm saying in plain English, that if an investment is leveraged and you're making payments on a monthly basis, well, Uncle Sam says just take an average of what the balance would be, you know, based out of those payments that are being made on a monthly basis throughout the year to determine your percentage of income that's going to get taxed. Eventually, again, all your IRA, if your investment gets fully paid, if it borrows, number one, good job. You did a great job. You basically just built wealth without using your own cash underneath your retirement plan. And at that point, once your IRA owns that particular piece of property, 100%, there's no more UBTI. There's no more UDFI. There's no more tax filings. Now, imagine that in a traditional IRA. That's already great, right? But imagine if this was a Roth IRA. You basically built your Roth IRA by using whatever's allowed under law. It's not a get-rich-quick scheme. It does require a little bit of diligence, and it does require a little bit of tax filing and work. But eventually, if that investment is tax-free, tax-free in your Roth, not only will you enjoy the tax-free benefits of that investment, your descendants will also enjoy the tax-free benefits of that Roth IRA, because any distributions that are distributed after your death, or even while you're alive, if you've had a Roth for 5 years and you're 59 and a half were disabled, but once you die, your beneficiaries will also enjoy the tax-free distributions out of your Roth IRA for the rest of their lives. Anyway, I had to add that in there. And your question was just basically, what was I trying to say? Your question was, does it have to file a tax return if UBT, does it have to file a tax return every year? All right. Once you sell an asset that generated, okay, next question. Sorry, I read the same question again. How could UBIT be triggered by holding a convertible note? If the IRA invested fully, and a convertible note will not generate UBTI. Let me just tell you that. Convertible notes typically convert into stock. So if you fully purchase that with IRA assets, then it won't generate UBTI. You can't leverage an investment anyway and borrow that from a corporation that may be disqualified. So that's another question, right? How does this affect crowd-funded projects that have a senior loan? A little confused. So if an IRA invests in an investment, right, and the project basically borrows, maybe this is your question, that investment, I would assume, would basically K1 people that are invested in that particular investment. Check the K1, check the type of income that investment is basically pushing back to an IRA that invested in a particular investment using crowdfunding. And that K1, as it's broken down, there's several lines in there. Line 1 would be trader or business. Check it with your tax advisor. IRS Form 1065 breaks down the different types of incomes. Whatever line they complete will determine for you whether or not it will generate UBTI. If they don't declare any portion that's that's subject to UBTI, well, then there's no UBTI. It really depends upon how they declare it on that K1 that is provided by an organization. Right? Please discuss that there is an exception whereby 401k plans don't pay UDFI with respect to rents. Now, the main portion of this course actually says, please discuss that there is an exception where 401k plans don't pay UDFI with respect to rents. Let me qualify that question. All right. UDFI, unrelated death financed income, deals with again, income derived from dollars that were borrowed. The rental income typically isn't taxable unless that portion is derived from that portion that was borrowed. That's the IRA world. In the 401k plan world, there is still UBTI. If a 401k plan invests in the business, the income received will be taxable as unrelated business income tax. However, there's a wonderful provision under Section 514C9. That's where the nerd part of me is coming out. 514C9 of the Internal Revenue Code basically says if a 401k plan generates unrelated debt financed income, that income will not be subject to tax. Now, why is that? Keep in mind, 401k plans are typically designed as an employee benefit plan to benefit employees. Right? Now Congress is saying if we really want to encourage people to grow their wealth in retirement plans so that we don't have to take care of them when they reach retirement age, let's waive the taxation on plans that are under Section 401A of the code. Well, 401A of the code is basically the code that deals with what we call qualified plans, where we get the 401k plan. A, B, C, D, E, F, G, H, I, J, K, all right? Which means you have an opportunity for an employee to contribute to the plan, right? That's what makes a 401A plan a 401k plan, whereas that participant's contribution. Now, There are what we call 401k plans called individual 401k plans. Individual 401k plans are employers with no employees. Well, this 514C9 still apply to that qualified retirement plan? The answer is yes. So therefore, if an individual has a business and they establish an individual 401k plan, can they use the money that they have in their 401k plan to purchase a piece of property and use a non-recourse loan, which could generate UDFI, but instead it does not, because 514C9 says that 401A plans, which are 401k plans, are not subject to UDFI. So to answer your question, 401k plans that invest in an investment and the 401k plan borrowed a non-recourse loan through a non-recourse loan to purchase that property will not generate UDFI. They haven't plugged up that, they haven't closed the gap for that particular section of the Internal Revenue Code. So right now, I can tell you there is no UDFI for 401k plans. There is UBTI, but there is no UDFI. I hope that answers your question. Kind of gave you a long, drawn-out explanation, but we have a lot of people that are answering, that are taking this course that have never heard of that. That's why I had to give the background a little bit. All right, next question. Does income from an orange plantation in Paraguay qualify as UBIT? My ownership is through an LLC owned by my IRA, and I do own the land itself. Whoa. I do own the land itself that the orange trees are on. Okay, so let me just answer your question. If your IRA is invested in a business, all right, and that IRA received income that's derived from a trade or a business, is that taxable? The answer is yes. How that other arrangement that you have is working for you, I would say talk to a tax advisor. There may be other issues involved in regards to the arrangement that you're doing. Right. All right. Here is another question. Does the investor tell Entrust their tax liability, or does Entrust pay the tax from the IRA to the IRS? Entrust does not manage your IRA. It's a self-directed account. Therefore, all the affairs are basically done by the taxpayer, the one who opens up the IRA. So if the IRA is subject to UBTI, work with a tax advisor to determine the amount of tax that is owed. You need to instruct the Entrust Group to take a portion of the cash that you have in your account to pay the tax for that particular IRA. So I hope that answers your question. We don't prepare the tax return. We don't tell you what the liability is. Those all have to be figured out by you and your tax advisor. Under Article 5 of an IRA document, it's the grantor's responsibility to make sure that all reports are provided to the Entrust Group. And the Entrust Group basically just does all the reporting. We don't do any sort of managing or responsible for any tax liabilities of any IRA we administer. So again, pull in your tax advisor from there. We will help in signing the 990T on behalf of your IRA, but we don't determine the tax liability because we're not a tax consulting firm. All right. Okay. LLC, you're talking about setting up one within the IRA, not investing in a private placement, correct? I'm confused with that question. We're not talking about setting up an LLC at all. We're just talking about certain scenarios where individuals may have set up an LLC. So, Mark Nuovo within the IRA. This course is not talking about telling anybody to set up any sort of LLCs. We're just talking about clients that may have invested in an LLC. So, next question. If I hold multiple private equity investments in my self-directed IRA, is the annual $1,000 income test the combined net income of all different investments in the IRA? Meaning, do net losses offset the net income? If your investment in equities that is not leveraged, there is no UBIT. So Oh, so the $1,000 doesn't even come into play. Dividend income, interest income, as an example, those are all deferred under an IRA. In other words, it's like Vegas. What happens in the IRA stays in the IRA. What happens with the business, all those are all suppressed. UBIT is only associated with income that is derived from a trade or a business. Dividend income, interest income are all exempt from UBTI. So I hope that answers your question. I have an investment in an LLC that used some debt to acquire some commercial property. I invest through my Roth IRA. I'm a 15% owner by equity. The distribution from the LLCs are deposited into my Roth. Are the distributions into my Roth taxable, or the distributions from my Roth taxable? Multi-layered question. When you're talking about distributions from your Roth, that's a completely different issue. We're talking about the income received from that LLC that may be subject to UBTI. Check the K-1 of that received from that investment. With your tax advisor, you'll be able to determine whether or not there's UDFI on that K-1. If there is an amount, that amount will determine the amount that's taxable to the Roth IRA. The Roth IRA will have to file a tax return if, again, there is that type of income, and they will have to file that using the 990T. Now, your next question is my Roth IRA taxable or not? That's a different question. Those assets that you have in your Roth, if you take a distribution, it will depend on whether or not you've had a Roth for 5 years and one of the three: death, disability, or attainment of 59.5. If you've had a Roth for 5 years, and let's say you're 59.5, all your Roth IRAs are tax-free if you take a distribution. Right? UBTI is associated with income received, earnings received by the IRA while the investment is still in the IRA. Once you take that distribution, a whole new different set of rules come into play. Right? I hope that answers your question. What are trust tax rates? That will be something that you could find under the IRS Form 990T. They're a little bit different. Prior to the Tax Cuts and Jobs Act of 2017, which was effective 2018, trust tax rates were comparable to corporate tax rates, which are a little bit higher, actually a lot higher. But with the Tax Cuts and Jobs Act, that has changed a little bit. So check with your tax advisor on that. Publication 990T may be a good starting point to find that information. Where you have leveraged real estate for purposes of calculating UBIT, does the calculation include deductions as debt service purpose for calculating taxable income? Yes. Talk with your tax advisor. When you're calculating that, it'll have the determination under publication 598. If my IRA becomes a limited partnership if my IRA becomes a limited partner in an LLC, in other words, your IRA, which is a member in an LLC, right, that purchases a commercial property and pays out dividends generated from operating income, rent, as well as profits, share upon exit, will UBIT be applied for all of that? If it's not from a leveraged investment and all it's paying is dividends, no, there's no UBIT for that. If the money that was used to purchase the investment had no leverage to it, there's no UBIT, especially if the income that is paid by the LLC are dividends. I hope that answers your question. Who pays UBIT, the IRA or the beneficiary of the IRA? The IRA will, because it's the IRA that owns the investment while it's sitting as a tax-deferred account. All right? Keep in mind, IRAs are similar to a holding tank. It's not going to get taxed until you take it out. When you take it out, that's when it gets taxed. Whoever takes the distribution, whether it be the IRA holder while they're alive or the beneficiary upon the death of the IRA holder, is the one that's going to take the brunt end of the taxation upon distribution. So while it's sitting in the IRA owns the investment. If the investment incurs UBIT, the IRA has to pay that tax. So let's hope there's enough cash in there, right? Can I convert my self-directed IRA from a traditional to a Roth so that gains going forward will not be taxed when I take it out? The answer is yes. Conversions from a traditional to a Roth will incur taxation in the year of conversion based on the fair market value of whatever's been converted. So that's the first question. The answer is yes, you can convert it, but there will be tax. There will be no penalty regardless of age. You can be 39 years old and convert your traditional to a Roth, and the growth on that eventually will be tax-free. I don't know about you. I'd rather for it to be sitting in a Roth IRA. But if some people can't afford it, well, then only convert incrementally, percentages. Great strategy, all right? Okay, here's the next question. If so, can you still contribute to the self-directed IRA each year, or do you need to open up a new one? You can add to the same self-directed IRA. You don't have to establish a new one. You don't have to establish a brand new IRA every time you make a contribution. There are some people that do so. I don't know why, but you don't have to. You can contribute to the same IRA. Some people set up multiple IRAs because they have different beneficiaries in there so that it prevents people from arguing, but there is no point in setting up multiple IRAs just to make contributions, so on and so forth. You can have just one if you wanted to. All right. I hope that answers your question. Makes it less expensive for you. If I invest in an LLC through a registered investment advisor who then purchases a multifamily property with property-level financing, will I be subject to UBTI? Check the K-1 on your LLC. Again, the K-1 will tell you the different types of incomes received from that LLC that you invested in. And that will determine for you whether or not there will be UDFI. Right? When you are calculating UBTI and paying UBTI, do you take depreciation on the real estate? If so, assuming the property is distributed to the beneficiary of the IRA, is the value of the depreciated value is distributed or the market value? Again, multiple layered questions. Okay. When an IRA owns when an IRA invests in a piece of property without a non-recourse loan, depreciation cannot be taken. Right? Why? Because it's a tax-deferred account. It's not getting taxed already. It doesn't work the same way as the property outside of an IRA. But if the property has UBTI, that's something to consider and talk with your tax advisor about on how you would deal with that portion that is not directly owned by your IRA, but through a lender, because it's going to be construed as if it was not, or viewed as if it was not, that portion is not under the IRA because it was used by, it was purchased using a borrower. So that's something to check with your tax advisor when it comes to that. Again, I'm going to defer that to the tax advisors. We're not tax advisors, but you know, all the depreciation, which typically used as a tax deduction and so on, you know, that doesn't apply to IRAs. If you bought a piece of property outright, right, and the IRA owns that property outright, upon distribution, the fair market value of that particular property will be reported as taxable income in the year of distribution. So depreciation will not affect that portion that is owned by the IRA. The portion that is not owned by the IRA, until it's paid off, right, may be able to do something with that, but not the amount that's under the IRA. The fair market value, again, will be reported on a 1099-R in the year of distribution. Right. Do you have any good resource on how UBIT is handled for state income taxes of individual states? Do states without income tax still? That I don't know. I'm not quite sure. The only place that I found a lot of good state or a reference that references to state taxation is retirementliving.com. And they used to have a list where you can actually click on that state and it tells you all the different taxes that are associated with a particular state. Again, I'm going to put a disclaimer. We don't follow state law. There's just too many of them. There's 50 states out there and they're dynamic. They can continue to change. But again, you know, vet it out. There's a website called retirementliving.com, and there used to be a visible tab, but I don't know, websites change. If you click on it, taxation by state, it'll kind of refer you to that section, and there's typically a link to the Department of Revenue for that state, and that would be a good place to start researching for your question, right? I hope that answers your question. Confirming that funds from current employer's 401k plan cannot be transferred to a self-directed IRA. Only funds for former employers can be transferred. The answer is yes. In a 401k plan, you have to have a trigger. We call it in the industry as a distribution trigger. Another term for that is a distributable event. In a 401k plan, you have to separate from service, died, become disabled, or the plan terminates, and in most plans, a qualified domestic relations order, in other words, a divorce, will allow for you to take money out of that account. In 403B plans, in other words, if you're a teacher and you have a 403B, you have to be 59 and a half, separate from service, death, or disabled, similar to that. Governmental 457B plans also have their triggers. There is a publication 560 that actually speaks on the different types of retirement plans, and that's where you can find those typical distribution triggers. Now, there are also other 401k plans that allow for you to take employer dollars, vested employer dollars, while you're still working. It's called an in-service distribution. If there are no stipulations, in other words, there are no stumbling blocks on an in-service distribution, you can take your vested employer dollars that have been in the account for at least 2 years, if that provision is a part of your 401k plan. That would be one way. You can't take everything, but at least you can take your employer dollars if the plan allows for in-service distributions and the in-service distributions does not have any stipulation. Some in-service distribution says, you can only take an in-service distribution upon attainment of 55, or there are several reasons, mainly what we call hardship reasons. Well, if that's the case, then not allowed, all right, because Congress basically in 2001, with the passage of EGTRA, the Economic Growth Tax Relief Reconciliation Act of 2001, codified into law effective 2002. If any distribution from an employer-sponsored plan is on account of hardship, that's not eligible to be moved, or in other words, rolled over into a self-directed account. I gave you more information than you probably care to hear about, but that's the rule. So, again, you have to have a distribution trigger to move assets from a 401k plan to an IRA. Yeah. Can an IRA invest in cryptocurrencies? Sure. I mean, the thing that FINRA, SEC, what's the other organization? Anyway, it's skipping my mind right now. Several investment organizations are kind of scratching their head. How do we regulate this thing? Because they haven't figured out how to treat cryptocurrency. So some organizations may have platforms that they could actually allow IRA holders to invest in. Sure. I mean, there's no prohibition for cryptocurrencies as long as it's not a prohibited transaction, meaning that you're not investing in your own cryptocurrency that you created. But yes, to answer your question, yes. But again, in the last panel that I attended were the Deputy Director of Enforcement for the SEC and FINRA and I think it's NASB. They all were in there, and the IRS was there as well. We're all just trying to figure out how do we handle this thing called cryptocurrency, but it's not prohibited under law. All right. Next question. Which K-1 line item are UBTI? I would highly recommend go to a tax advisor, and then they'd be able to assist you with that. All right. Do you pay tax from your IRA account or personal account? Can you roll it in? Can you roll it to a future year? No, the tax has to be paid in the year from your IRA when it comes to UBTI. So it cannot be paid out of pocket. It has to be paid out of your IRA because the IRA is the one that owns the particular investment. Does Entrust set up self-directed individual 401k plans? Yes, we do. We do. We do set up self-directed individual 401k plans. Keep in mind, make sure that you don't have any employees because I've heard many times somebody, I want to establish an individual 401k plan, and come to find out in the process, they go, well, I have 2 employees. Could they participate too? And the answer is, if they're eligible, you don't have an individual 401k plan. You just have a regular 401k plan. Well, I'd like to set up one separate for myself and my employees. You can't do that. The Department of Labor says if you own a business, you own and control it. You have to give the same benefit to yourself as you would to your participants. Anyway, I give you more information to your question, but does Entrust set it up? Yes, we do. All right. Next question. Where would we find the name of the company that does non-recourse loans? Yes, I understand that Entrust is not endorsing them, but just providing their name. So we actually have a list. If you want a list of non-recourse loan lenders, go to our theentrustgroup.com, and we do have a list of non-recourse loan lenders. Again, www.theentrustgroup.com, and there is a list of non-recourse loan lenders that we help assist and provide clients that, you know, they're around out there. All right. I hope that answers your questions. And then you can compare rates, you can compare loan to values, you can compare what types of investments they would underwrite, not underwrite, because there are limitations on certain or firms that do non-recourse loans. All right. If I make a PP, I'm assuming PP means private placement investment with my IRA assets into a subject LLC, and my ownership interest generates income, dividends, royalties. Is it subject to UBTI? As mentioned earlier again in the course, there is a slide that says there are certain incomes that are not subject to UBTI, and those are your dividends, interest, and royalties. Those are not subject to UBTI, unless, of course, the LLC borrowed money, right? So, but generally, again, dividend, interest, royalty income, rental income is not subject to UBTI. Hope that answers your question. Right. I put the slide up. Right. In this example, my IRA is only an investor, and I have no control, officer relationship to the LLC. Well, non-managing member of the LLC. Great, you're just an investor. If it's interest, dividends, or income, or if it's rental income derived from, not derived from leveraged, or in other words, they didn't borrow money, if all that you're receiving is basically purely investment royalties, you know, royalties, dividends, and rental income, no UBTI. Again, I hope that answers your question. Is there such a thing as a Roth 401k? Yes, with the passage of the Pension Protection Act. Well, actually, this was under EGTRA too, the Economic Growth Tax Relief Reconciliation Act of 2001, effective 2006. 401k plans can offer such a thing as a Roth 401k plan. As a matter of fact, the big difference is the fact that in a Roth IRA, there are income limitations to determine whether or not you're eligible to contribute to a Roth IRA. In a Roth 401k plan, there isn't one. There is a limit called the 402G limit. In other words, the maximum deferral amount that you can put into a 401k plan in a particular year. All right? There is a maximum. There is also what we call a catch-up contribution, that if you're 50 and over, you can put an amount above and beyond that. That's only for people who attain age 50 or older before the end of the taxable year. So to answer your question, is there such a thing as a Roth 401k plan? Yes. And we actually establish a lot of those at the Entrust Group. It'll have to be a separate account. Why is that? Because the Roth deferrals must be tracked separately, because those assets will eventually be tax-free. You don't want to commingle that with dollars. They're still going to be subject to tax, right? I've used a self-directed pre-tax IRA or 401k money to invest in a real estate project and later changed my mind and want to use a Roth money for the investment instead. Can I make that change? Unfortunately, once you do that, no, you cannot. There cannot be a sale or exchange between an investment that is owned by a disqualified party, that's you, and exchange it with yourself. I wish you could. You couldn't. You can convert your pre-tax dollars into a Roth, but that will require taxation, right? Because in the year of conversion, there's going to be taxation. You can't just switch those dollars within one IRA to the other without any sort of taxation or, yeah. I hope I answered your question. Are capital gains subject to UBTI if you have a property level financing, or is it only the rental income that is subject to UBTI? Well, if you have a property that you bought for $100,000, right, and now it's worth $200,000, the gains on that's typically non-taxable. However, if you use leveraged dollars, if you borrowed money to buy that $100,000, whatever that proportionate share is, that percentage will be applied to the typical capital gains, and that amount will be subject to capital gains tax because the IRA did not have the money to purchase that that amount, unless of course the loan is paid in full. But if the loan is not paid in full, whatever the outstanding loan amount is, whatever that percentage is, will be applied to the capital gains, and that amount will be subject to capital gains tax. I hope that makes sense. So the moral of the story, don't sell it until you've paid off your loan. Because once you paid off your loan, there's no more gains. Why is that? Because it's all the IRA's dollars at that point. I hope that answers your question. All right. What kinds of transactions does Entrust not support? You said at the beginning you reserve the right not to handle all types of transactions. What I mean by that is if we see that somebody's trying to engage in a prohibited transaction, we will reserve the right to say no to a particular transaction. We do get approached by people, and you know fully well what you're looking at is not going to fly. Those are the types of transactions that we typically shy away from. Anyway, I hope that answers your question, and I hope you found that this seminar was fruitful for you. I hope that it raises some awareness and excitement for you to continue to explore all the possibilities out there that's available for a retirement plan investing. My name is John Paul Ruiz, Director of Professional Development here at the Entrust Group. Please call us. It may not be me personally, but one of our reps should be able to answer a lot of your general questions that you have in this particular course, and we look forward to having you again at one of our Entrust webinars. And have a great day. Thank you.